I want to get your take on Jay Powell yesterday. What did you make of the speech?
Well, it's kind of like he's overcooking the goose. They're playing catch up. And while they were doing quantitative easing in 2021, inflation started to rage, and now they're trying to catch up. Our 21 Lehman systemic risk indicators that look at equity and credit point to one of the highest probabilities of a crash in the stock market looking out 60 days.
Wow, 60 days? You're saying you're going to see it? We're going to see a crash in the stock market within 60 days?
Yes, because the withdrawal of capital from the middle class families is so spectacular. For every 1% increase, now a lot of these economists and Wall Street people, they throw around, oh, the Fed's hiking basis, 100 basis points, 50 basis points. The bottom line is for every 1% increase in rates, and we've done almost 5% now, every 1% takes $50 billion out of the pockets of middle-class families. Auto loans right now are approaching 14%. Almost 20% of auto loans are $1,000 a month. And so the middle-class families are getting hammered here. And so the consumer pressure is, violent. But on the high end, the wealthy are doing well with excess savings and higher interest rates.
Larry, before you get into what we're looking at in terms of rates and the impact, I want to bring Adam Johnson in here because he's on the other side of this trade.
No, I'm not expecting a recession. And my argument is the two E's of earnings and employment. Employment's at an all-time high, and earnings, while not stunning, are better than feared, and revenues are actually rising 5%. Larry, I'm curious, you made the comment that there's some sort of pending crash coming up in 60 days. That's a pretty bold statement. Days. 60 days, Larry? Do you really believe that your indicators are right and that there's some sort of crash when you have the most amount of people ever making the most amount of money ever, spending the most amount of money ever, and it's translating into earnings that, while not stellar, are enabling revenues to actually rise?
Well, remember, if you have $10 million in the stock market 2 years ago, you're flat. Okay, so there's a lot of people that have had money in the market for a long time. All these failed rallies, that's beating on the psychology of investors, number one. Number two, $10 million in cash today generates $510,000 a year in treasuries, in 1 year treasuries.
Wow.
Okay, think about that. A year ago, this was $70,000. We have to do the math here, okay? Common sense. So you're even in the market. You've been in the market for 2 years in these moronic FANG stocks that have gone nowhere, right? The most crowded trade on earth. You're flat to down after 2 years. And now you're looking over at a money market fund or a 1 year treasury, and you get $510,000 of interest risk-free when a year ago you were getting 70.
The average investor is smart enough to recognize there's now a choice between stocks and bonds. So that average investor is going to say, I'm going to sell my stocks and I'm going to go buy bonds and just make 5%. Is that basically where you're getting the notion?
Yeah, that's exactly what he's saying.
Right?
There's real competition now to stocks.
Let me ask you a question, Maria. Elaine Gazzarelli in the 80s, right? And you were probably too young for this, right?
I remember Elaine Gazzarelli. No, I remember. She was a real long-time bull.
Well, she was a long-time bull, but you know what flipped her is her model. She had this risk-free model versus equities, and it made her so famous because in the summer of 2007, the risk-free rate went up so much, she flipped to bearish because of that risk-free rate threat to equities. I'm seeing a similar dynamic now. An incredible stat is 2s, 10s are 100 basis points inverted. So that means the 2 year treasury is 100 basis points more than 10s. That's threatening. But then on top of that, you look at the underperformance of the regional banks. So your regional banks are your classic canary in the coal mine. They're underperforming the S&P by like 6, 7, 8% over the last 6, 9 months, a year. So the regional banks are telling you something really bad is happening under the surface in commercial real estate, auto loans, residential. There's really massive cracks under the surface. And that's why the market probably goes down 10, 20%, maybe 30% the next 60 days. 10,
20, 30% in the next 60 days. What do you do and what do you say about the jobs picture? We've got the February jobs report out on Friday. So how do you have a recession? How do you have a stock market sell-off, a crash when we get this kind of job growth?
Well, if you look back at 2000, right, the biggest number in jobs right before the 2000 drawdown, 2001, the strongest number in the previous year and a half was literally right before the market buckled. And one of the weird things is, and Adam's alluding to this, and I can see what Adam's making a good point. Jobs are strong. But if you look at, when I talk to behind me, we run an institutional chat with about 650 investors around the world. And one of the things they're talking about is when you have this January number that was so spectacular, it's gotten a lot of people excited about a soft landing. But if you look back the last 20, 30 years, when you have this seasonal adjustment in January, typically the February, when you have that spectacular kind of outperformance, which is seasonal, typically there's like a mean reversion in February and March. And that's why you probably get like some nice move down in jobs, which will which actually help the Fed a little bit. If unemployment goes up, it'll give the Fed a little breathing room, right? So that may in some ways help. But in that case, you want to be long gold miners and things that will benefit emerging market equities, things that will benefit from the Fed cutting rates.
Well, based on all of your research and your conversations with all those institutions, where do you hide away from gold? Is that it? I mean, gold is a hedge. You say buy the gold miners in the stock market. Are there any other areas to hide within the stock market if, in fact, these predictions are right, that we're going to see a stock market crash within 60 days?
Okay, one of the things we're looking at is from 2001 to 2003, 4. I was on the Lehman trading floor in that period. And when you went around the trading floor after the dot-com crash, the most popular investment was European global equities. And if you look at a chart, Adam can pull this up for you later, but if you look at a chart of the global equities ex-US, okay, global equities ex-United States, versus the NASDAQ versus the S&P, you're breaking a multi-year down channel. You're talking about 10, 15 years of massive outperformance from the United States. Now, for the first time, you're seeing spectacular outperformance from global equities, MSCI ex-US, which we would say. That is where the outperformance is going to be.
Well, I mean, I have a hard time believing that in fact, if the U.S. sells off, we get a stock market crash, the rest of the world doesn't follow. And that MSCI index is loaded with Chinese stocks. So there's that issue as well, the China threat.
Yes, the EWU, well, first of all, you're 100% right. In the initial drawdown, the European equities will underperform with the U.S., but they'll outperform the U.S. over the next 2 years. Okay. The EWU portfolio is a golden portfolio of value global equities. EW, it's referenced as the United Kingdom, but it's a Hall of Fame basket of like global value equities. Yeah. That's, I think, that hard asset basket, that's the basket that's going to outperform what we call financial assets in the United States, so growth stocks.
All right, Larry, we'll be watching. Is there a trigger for this stock market crash?
The trigger will be like the S&P earnings. Everybody's expecting, the street is expecting $226. Yeah. That's priced for perfection. So what happens is when we deteriorate in jobs the next 2-3 months, that will bring into question the S&P earnings, and the S&P earnings are probably 190, so that'll trigger it.
And that's the Stephanie Pomboy narrative. That's what she's been saying on this program now. It's going to be a profits recession.